Dipen Seth, Head of Institutional Research with HDFC Securities, who joins us live from our Mumbai studio. Dipen, good morning. Thank you for joining us. First, how would you characterize the recent price action in Indian equities? Do you think Indian markets have lost momentum and the macro trade is coming under pressure?
Yes, I would agree with you on that, Nikunj. I think right now the single biggest factor that is influencing the gyrations in the market is the nature of the currency movements and the associated capital flows, which are, leading to some of these currency movements or feeding on them. So it can work both ways. We saw that in the slightly less than recent past when inflows remained strong. We had very strong FII inflows for much of this year, and I think cumulatively we are still at about $16–17 billion, and that kept the currency strong, and then suddenly a little bit of a sell-off, and then it started feeding on itself. So I think this entire business of a liquidity-driven market is something we'll have to live with for some time to come.
Depends. So what is it that you expect to see from the markets? Because we seem to have got into a turbulent path, so to speak, can't even hold on to 6,000 sort of levels, very narrow, sharp moves coming in, either this way or that.
Well, what's happening is that there is little by way of policy action. We seem to be dependent on things to happen to us rather than do something as a country. The government is pretty much asleep. Sorry for the broad brush generalization here, but there's been very little policy action which encourages people to set up new plants or manufacturing or new services or expand capacities. The structural problem with the Indian economy for some time has been that capital formation is not taking place, the investment cycle is not taking off. And I guess, Aisha, the next leg of economic growth can only come from an investment-led or a capex-led uptick. Something that even the government has switched itself off on. If you will notice, they've been managing their finances by relying, by shutting off the taps on planned expenditure. So there's very little by way of inspiration to set up new capacities in this country right now.
There are 2 R's for the month of June. First is rains and the second is rates. So which R do you think will have a bigger say in the month of June?
Well, like I said, we keep relying on things to happen to us. So I hope we have a good monsoon. I think the prelim indication here is that by any stretch of imagination, with whatever little data that's coming in right now or anecdotal evidence, I think we should have a fairly decent monsoon. And so that R, I think, is pretty much in place. Things can always go wrong with the weather. On interest rates, I think there was a consensus view that with inflation at a multi-quarter, multi-year low, some kind of loosening of taps by the RBI would lead to happier times. Very recent commentary from the RBI has been less than encouraging, but I think that's just a case of managing expectations. We are betting on maybe 25, and if we are lucky, a 50 bp rate cut, and that itself should give some more encouragement. But the disclaimer here, Nikunj, is that lower interest rates by themselves do not mean much for businesses to get confident about the economy. Of course, there are takeaways from lower interest rates for a variety of sectors, but by itself, an interest rate doesn't mean too much.
Dipen, what's your sense though? I mean, can Narayana Murthy revive Infi's flagging fortunes?
I wish that was the case, and I suppose that will be part of the perception for a while. So internally at the office we say this is NRN 2.0 for the failures or under deliveries on Infosys 3.0. That sounds like a good catchphrase. It makes sense to quickly latch on to NRN as the next big thing to happen to Infosys, and the return of the patriarch will set the entire house in order. And we're a little skeptical of what it will achieve in real terms. Of course, it's a service organization. It remains a great company. And but much of the failures of the last few years are things where the company has gone wrong in its basic understanding and its go-to-market approach in the business. And to get back your founder at age 67 with his son in tow doesn't look like the sort of great thing that Infosys is known to do. So we remain skeptical, but we completely admit that this is going to be a sentimental boost not only for the markets but even for a whole lot of employees whose morale was sagging for a while.
Right, so at 2500, do you think all the good news or the NR Murthy adjustment is in the price? Because sentimentally things have changed, but materially things will not change.
Quite frankly, and to be fair to Mr. Murthy, I think we'll have to wait to see whether he can pull back some of his magic. I hope he does. I'm a little skeptical whether he can do it in a very big or meaningful way, but I think we need to give space to the man now to perform, and a lot of tricks have failed at Infosys for a while now. So why not wait for one more trick? Let's be patient. This remains the greatest startup in the history of this country. NRN is arguably, one of our best-known founder entrepreneurs from this country. So why not go out on a limb and take this chance for a while? But if you tell me what is the quality of the decision, I'm not too impressed.
Dipin, what are your thoughts on Pharma? Because Pharma as a group now is not looking all that charged up, and the news flow suddenly for Pharma as a sector is mixed. Whereas Sun Pharma is growing, Lupin is growing, but there are problems for a Lupin and a Glenmark.
I think in Pharma, we are seeing a lot of disparity in the way they are reporting progress in their businesses. So some of them are getting into regulatory issues, whether it's around Ranbaxy, and for some time we had a delay in approvals coming through for Cadilla's new facilities. The guys who have done their regulatory homework, their product selection right, and their markets and geographies correctly, strong operations, R&D at the back end, are guys who've been the super performers over the last few years. So names like Sun Pharma stand out, Lupin stands out. And there is this disparity or divergence in performance is going to continue for a while. There are some opportunities though. At this point of time, I think valuations at Divi's, for example, favor the believers. It has a very, very high quality business. And I think in the slightly lesser known stocks, you might see some opportunities.
I just want to get back to IT. You like Mindtree. Why is that? A valuation play?
Yes, the stock looks cheap at about 9x F14 earnings, and there's been a little bit of a sell-off recently. I think the sell-off has coincided with the broader sell-off in IT. I think IT, even the large caps have suffered, and the IT index is amongst the worst performers in this calendar year so far. One, the rupee was getting a little strong. Two, there were regulatory noises, opposition from more conservative factions in the US coming against outsourcing. And then the visa restrictions kicked in, so people began to lose a little bit of faith. Let's keep in mind, Aisha, that this is an industry or a sector which has been a consistent world beater for the last couple of decades at least. This is one of the few things at which Indians are better than the rest of the world. So let's not be in a hurry to write off this sector just because there's a little bit of a hurdle or an increase or raising the hurdle for these companies in their larger markets. I think they're smart enough to figure a way out. And if you're getting a high quality business, decent return ratios, clean cash flows at 9x 1 year out on very healthy margins, I think you should buy a company like Mindtree. It's not as small a mid cap as you might imagine at about $500 million revenues.
Dipen, how did you read into the trends coming in from the monthly numbers from autos?
Well, you had a volume crack at Bajaj, the Maruti numbers were disappointing, and I think the one thing that stood out in the auto numbers this time was a little bit outside of auto, if you will allow me to say this, and which was the huge uptick in Mahindra's numbers on the tractor space. So I think this is a remarkable company. The core business works at very high return ratios, the core auto business, if you strip off their investments. And I think with the prospect of a good monsoon, a company like Mahindra stands to gain, especially as we are anticipating a little bit of an easing off from their passenger vehicle or CV business as well this year. So it's a very interesting bunch of businesses there, and largely protected because of the diversified nature of the business mix.
Dipin, what is your understanding of the new RBI clarification on bank licensing guidelines? Do you think the fresh clarifications which have come out yesterday will only make life slightly difficult for all aspirants?
We are not very clear. I think we will, let's be humble here, we will have to go through the fine print here and come back with a more genuine view.
Dipen, before we let you go, leave us with your stock ideas from the media space. You do like that space.
Yeah, so in media, I think there are two ideas worth talking about. We've seen a very large announcement of a payout from the folks at Z after a fairly decent quarter. I think in principle, any payout from a cash-rich company is to be welcomed. We were a little puzzled to see the method they chose. They chose to issue bonus preference shares. And to my mind, that looks like an unnecessarily complicated thing to do. Now, keep in mind that Z has been traditionally stingy on payouts, and over the last 2 years, we saw a remarkable transformation, not only in terms of earnings growth and structural drivers playing out for the company, but also an openness and willingness to distribute these profits and cash flows to shareholders. Dividend was stepped up, a couple of buybacks were taken up, and naturally the stock re-rated as a result. Now at this point of time, if you commit to a 2,000 crore payout over a 4 to 8 year period as the structuring has been done, but do it through a complicated route like this, it just unnecessarily confuses investors. So initially the stock cracked a little bit, and the low coupon on the bonus preference shares also will have some value destruction element built into it. But I think the core business is doing very well. We would adopt a strategy of buying Z on dips from here, and I guess we will get it at lower points, lower entry points than where it is today. The second idea we like in media, in an associated space, if you can call it that, is a small company called Navneet Publications, just about 1,500 crores market cap or so. Trading for about 10 times F15 earnings, doing about 20-25% CAGR, earnings CAGR. It's a very interesting company, not only because of the high return ratios and clean cash flows, but because it's chosen to be in the supplementary textbook business in education rather than set up schools of its own and so on, which happens to be a very highly capital intensive and long gestation business with several entry barriers and regulatory restrictions. So this is one company that has very intelligently chosen a feeder model, so as it were, to education, and created a fantastic franchise over the last 40-50 years across two large states in Western India, which is Maharashtra and Gujarat. So we like Navneet at current valuations. For all the mid-cap fund managers and stock pickers out there, we think it represents very, very good value at this point of time.
Right, Dipin, appreciate the time and thank you for joining us.
Thank you.